Hello and welcome to BQ Prime. You're watching IPO Adda, and my guest today is from the first REIT which is going to be listed in the retail space, Nexus Select Trust. The REIT is being priced between 95 to 100 rupees a unit. They're raising nearly 1400 odd crores in fresh issue, and there's an OFS of 1800 odd crores. So the total value of the REIT is at 3200 crores. And joining me is Mr. Dalip Sehgal, who is the ED and CEO of Nexus Select Mall Management Private Limited, who the manager uh, to the REIT. Mr. Sehgal, thank you very much for joining us on BQ Prime. Let me ask you the first question here. You're raising 1400 crores in fresh issue. What is the proceed going to be used for?
Okay, hi, good morning, and thank you for having me on your show. I think basically the 1400 crores is being used for repayment of debt. As you know, as we list, we need to prune the debt. So most of it is going to be used basically for repayment of debt at the SPV level.
Okay, give me a sense of the spread of this properties, because you are in 14 cities, 17
Sure.
properties, consumption
Yeah.
centers or malls, what we call in local parlance. So
Yes.
give us an idea of how big is this properties. What is the kind of uh, growth potential which is there in these markets for you?
Okay, fair question. We have 17 assets as of now, almost 10 million square feet across these 14 cities. To give you a sense, we are in almost all the metros. We have Select City Walk, which is a marquee mall in New Delhi. We have an asset in Navi Mumbai. We have 3 assets in Ahmedabad, Chennai, Hyderabad. So we are almost in all the metros. We are also in some of the important mini metros like Pune, Ahmedabad, Indore, and we are also in a very nice strategic location in Chandigarh, which is the Elante Mall. Elante is unique in the sense that it's not just the city of Chandigarh, it's at a tri-junction of 3 states. So consumers come from Punjab, Haryana, Himachal, and also a large number of NRIs during winter. So if you look at that portfolio, it is pretty well spread across the country. And we are perhaps the only pan-India mall operator, because most of the people, as you would know, are focused on a region. We have a pan-India presence. So that's one. The second thing is that you asked about in terms of how the business is doing and what is the growth like. I think pre-COVID, we were growing at about 11% CAGR. Obviously, during the 2 years of COVID, there was a drop in sales, malls were shut, and all of that. But the good news is that post that, the recovery has been very, very strong. So we ended, let's say, the 9-month period, which is in the updated document, between April and December of 22, we ended at around 28% growth, which is over FY 19-20. So very strong growth. Number one. Number two, I think what is also heartening is the fact that almost all the categories have shown very, very strong growth across the portfolio. The third one is that, as you know, the last acquisition that we did was 8 malls from the Prestige Group in the south. This is acquired, interestingly, in the midst of COVID in March of 21. All these malls have also done extremely well, and they have also grown at 26% plus in this 9-month period. So I think overall a good, strong recovery, very good integration of the south portfolio of 8 malls. And today, as we stand, I think we are in a much stronger position than we were, let's say, pre-COVID. So a lot of lessons learned and a much stronger portfolio and a stronger business as we see it today.
So 9.2 million square feet is what you have today. That includes 2 hotels and, if I'm not mistaken, 3 office spaces. Do you plan to continue with the office spaces, or sell it off to the REIT from the same sponsor?
So, couple of corrections. I think 9.2 is our interest in the total
9.8 and 9.2. Sorry. So,
9.2.
yeah, I'm talking of economic
but
interest
that
of yours.
does not include the hotels, does not include offices. So that's separate. This is only mall area.
Okay.
We have 2 hotel assets, Chandigarh, which is Hyatt, and Oakwood in Bangalore. And we have office assets in Chandigarh, in Pune, and in Chennai. 95% of our business, interestingly, is all retail malls. Yeah, it has. So hotels and offices came to us as part of a co-development that happened. So if you take Chandigarh, Ilante, there is the hotel, there's a mall, and there are offices, and you can't bifurcate the three. So that's essentially the reason why they came into the portfolio. Going forward, the intent is to focus entirely on the mall business and not really on offices, and that's not core to what we do.
So offices would be divested in the future?
No, we could look at it. I'm just saying it's not core to our business, so we can always, and it's very small part. It's less than 5% of our income, so it
Okay.
doesn't really
So
impact business.
if I look at your geographical present, it's mostly in the western region and the southern region. In the north, Chandigarh is one of them, but entirely UP and the eastern part is not been covered by you, except for I think you have in Bhubaneswar if you have a property there. What is the strategy of expansion to other cities which is there? And I also want to know, since you are looking at consumption centers and where the highest amount of discretionary spends happen, you are absent
Sure.
in Mumbai. So, what is the reason for that absence?
Okay. I think you've asked 3-4 questions. Let me try and answer them. The first one is that in the north, it's not just select city. We have Ilante. So we have Delhi, we have Chandigarh, we have a mall in Amritsar, and we have a mall in Udaipur. So we have 4 assets in the north. East, you're absolutely right. We have only one, which is Bhubaneswar, which incidentally is one of our fastest growing, best performing malls. And yes, meaning East would be an opportunity as we go forward. It's an underdeveloped market for malls, but clearly an opportunity as we go forward. As far as Mumbai is concerned, while we are not in the city, we are in the Navi Mumbai area, which is again a very fast growing part of Mumbai. And it is one of our strongest performing assets, which is the Seawoods Mall in Navi Mumbai. So yes, these 17 are pretty spread out. How will we grow? I think that's an interesting question. Let me answer it in 2 parts. India has roughly 100 odd A-grade assets, which are A-grade malls, which are not strata sold in a reasonable location. And if you look at the top 4-5 guys, we have 17. And if you take the other 3-4, you're probably looking at 40-45. So what is available for acquisition, in a sense, is another 50-55 malls, which is around 30 odd million square feet, spread across the country, right? So that is the pool from which we would acquire. And as you know, our model is acquisition. We don't build ground up. All these 17 have been acquired over the last 6-7 years. So that's really the model. Where all would we go and look at acquisitions? I think in India, the good story is that the consumption story pans out not just in the metros and mini metros, but goes to tier 2 towns as well. I think classic example is are places like Amritsar, Udaipur, Bhubaneswar. Like I said, Bhubaneswar is one of our best performing malls. So we would certainly look at the 14 cities that we are in, where we can consolidate, and then go beyond that and look at certainly state capitals, which are becoming increasingly, big pockets of consumption. Just to give you one statistic, there are 115 towns in this country which have a multiplex today, right? So I think the day and age when people were talking about just metros and mini metros is over. I think India consumption story now goes much beyond the top 10-15 towns.
So, if that is the case, do you have any rights of first refusal for any of the upcoming projects where you can pick up properties, acquire from them?
Yeah. Okay. So we don't have any ROFO in the existing portfolio. The entire portfolio is fully built. So there is no further expansion possible in the current portfolio. Having said that, like I said, there is enough and more room for acquisitions as we go forward. Do we have anything on the table? Obviously, we keep talking to people, but as of today, I'm saying I can't obviously confirm anything to you. But clearly, if you look at our history over the last 7 years, we've acquired almost 1.5 million square feet every year, and there is no reason why going forward we should not be able to do a similar number. So, to answer your question, we don't have any ROFO, but the pipeline in terms of what is possible is certainly there.
So, give me a perspective of when you say that you have projected a net operating income CAGR of 17 odd percent in the next 3 years, 24 to 27. Where is the
CAGR of 8%, total of 17.
17%, yeah. So where is that growth going to come from?
Yeah. So there are 2 parts. One is the top line growth, which obviously will come from growth in sales. Our tenant sales pre-COVID used to be $1 billion. Post-COVID, it's about $1.3 billion, and we measure tenant sales on a daily basis for 90% of our tenants. So there is a top line growth that will happen. In terms of where will the NOI growth come from, there's a bridge that we have shown in the offer document. It will basically come from three areas. One, there is contractual leases which allow us, and that's 90%, 95% of leases have that, which is a 15% escalation every 3 years. So about roughly 5% escalation every year in rental incomes will come from the contractual agreements that we currently have. The second big portion is that 10% of our leases come up for renewal every year in terms of rentals. And if you look at the last 5 years, we've got roughly a 20% upside on the churn when it happens. So that's the second part that will help us. And the third, which perhaps is very, very important and a bit different from, say, some of the other REITs that are there, we have an upside. In retail, we have a very strong upside that's possible if business does well. This is called revenue share, as you may be aware, or turnover linked rents. Basically, it means that either minimum guarantee or revenue share, whichever is higher, is what is payable to us, right? So that accounts for almost 13% of the rentals that we get today. Pre-COVID, it used to be about 8 or 9%. So essentially, these are the three big buckets. One, contractual growth of 5% every year. Number two, 20% rentals, coming up for renewal. 10% coming up for renewal, and the upside being around 20-odd%. And the third one is a revenue share. 87 or 88% of our leases have a revenue share clause, and that gives us almost 13%. So these are the three big buckets, and then there are smaller buckets: hospitality, savings from solar, and so on and so forth. But these are the three big buckets in terms of NOI growth.
Okay, so give me a sense of the kind of profile of your clients as well, because 40% of your revenues are coming from apparels and accessories, and roughly, I would say, footwear is 10% and entertainment is around 9% odd, which is there. So, is it right to say that the focus is to have consumption centers which have at least minimum walk-ins with respect to theaters or entertainment which is there, and then you look at getting anchor tenants into these malls?
Sure. No, that's a very good question. I think basically, if you look at how malls are, positioned in terms of the portfolio that is available, they're obviously anchors, and in anchors you'll have fashion anchors, which are large, multi store or multi-brand department stores. Then you will have entertainment, which is the cinema, FEC, which is the family entertainment centers. You'll have F&B, and so on and so forth. We roughly have today across our malls almost 3,000 stores. More importantly, we have 1,000 brands. So I think one of the key things that I wanted to point out is that, look, this REIT is not just about being a real estate play. I think this REIT is essentially a consumption play. We're looking at 3,000 stores. We're looking at 1,000 brands. We're looking at 130 million footfalls, which is 2 times UK's population coming in and going out of our malls. And the fact that we have $1.3 billion in terms of tenant sales. So if you triangulate these 3 or 4 key things, you're basically saying that we are at the heart. Nexus Select is at the heart of India's consumption growth story. That's really what it is. To your question as to what do we do to sort of bring in footfalls, obviously a huge amount of marketing effort goes in, activation, etc., etc. And like I said, we also have daily sales coming in. So by the afternoon today, I will know yesterday's sale across all my 17 malls. So that allows us huge amount of headroom to say what is working, what's not working, and what is it that we need to actually improve, and not on a quarterly, monthly basis, but on an ongoing live weekly basis, right? So our tenant mix, you're absolutely right, has a mix of, obviously fashion is the largest, but if you notice over the last 5 years, and this trend will continue, F&B and entertainment. See, at the end of the day, what are we doing? We're catering to families who come on the weekend to spend time with us. India doesn't have too many options for people to go anywhere. So when they come there, I think the 2 things that draw them is essentially entertainment, and not just cinema. We have very large family entertainment centers as well. And and F&B, right? The food courts on a weekend, as you would have seen in a mall, are absolutely jam-packed. So these are the two things. Today, they contribute almost 25% of our business, and going forward, my sense is that this will only keep going up. Beauty is the other category, is interestingly, that's gone absolutely through the roof post-COVID. So, and then there is athleisure. That's the third category that's doing extremely well. And cinema does well in patches because it's completely dependent on the titles and the software that's available. If there's a good movie coming in, I think we see great occupancies and so on and so forth. That's really the mix that we typically look at. Yeah.
Just to get an idea of the business, because unlike a normal company, your company is more of a distribution income kind of thing. I mean, people should not be looking at companies for stock market returns on listing day, like for other companies it is. Here they should be looking at a distribution play, which is there, which 90% of your profits or distributable profits should be which you will be distributing to the unit holders. How do you compare yourself with respect to distribution income vis-a-vis other players in the market, your competitors? And I'm saying this from a point of view of because it's a retail REIT which is open to others, public as well. So in that sense, how should they look at this retail REIT?
Sure. So I think, again, a couple of things that you mentioned. The first one is in terms of distribution. Our distribution will be on a quarterly basis, and as you would have seen in the DoD document, we will distribute 100%, not 90%. We'll distribute 100%. So that's the first thing. Number two, you're right. I think the yield in this instrument could be around 8.5% odd. Over a 3-year period, it could be roughly about 9% odd. And for an individual investor post-tax, the yield would be around 7.1%, which is substantially higher than a 10-year GSEC. It is higher than what you would get in an office REIT, and obviously substantially higher than what you would get in an FD. So I'm saying, again, for somebody who's looking at a steady return, I think this is a great product. Number two, you said, is there appreciation? Of course, there is appreciation. And I think that is one big plus point that we have in retail. I just explained to you that there is an upside that we get in terms of rentals, which translates directly into increase in NOI. And that increases, like you saw in the 3-year projections that we've given, at roughly 8 to 9% CAGR. And that will result, in my mind, in an appreciation in the price as well. So you have 8.5%, probably 8.5% odd pre-tax, 7.1% post-tax as your return. And you have an opportunity for appreciation. So we are like any other business. So I think what has happened is that because there aren't too many REITs, people tend to club everything together. Yeah. Let me just give you one example. I'm sure when the stock market started, if let's assume that only technology stocks were being listed, right, and then the first consumer stock came in, they would say, hey, listen, are you also like a technology stock? The answer is no. So while today people have understood that you can invest in different stories, there's a technology story, there is a consumption story through consumer companies, or you can invest in a bank and invest in a financial story. Exactly the same way, I think it's not fair to just compare it with an office REIT, just because REIT as an instrument is similar to what is there in the office space. I think over a period of time, as the width and depth of this product increases, I think people will start figuring out what is the story that they're investing in. If I may say, as far as the Nexus Select REIT is concerned, the investment is essentially in a consumption story that revolves around 1,000 brands and 3,000 stores.
So, so the projections that you've given for growth in terms of net operating income, it does not include, as of today, any inorganic growth that may come in, right?
Absolutely.
So, if that comes in, it will there will be a further increase in your distribution income, and as a result of which your yield also enhances further.
That's right. So when you acquire, they're obviously on two sides of the balance sheet. You will have.
So what are the factors that you look at
Yeah.
what are the factors that you look at when you are acquiring an asset?
Yeah.
Should it be operational or cash flow positive before you acquire, or is it at the initial stage that you acquire and develop it?
Yeah. So two questions. I think the first one that you asked was in terms of our ability to acquire more assets at the time of listing. Our loan to asset value will be around 16 odd percent. Most of the REITs operate at 25 to 29%. That gives us a headroom of about $500 million in terms of acquisition capacity on the debt side. On the equity side, clearly, REIT as an instrument for somebody who's rolling in. If you take the example of Nexus Select, if you take the example of Select in Delhi, clearly one of the best performing malls. One of the reasons why they are rolling into the REIT is that when you roll in, you're converting a physical asset into a financial asset with no tax implication at that point in time. So if they were to sell that asset, the capital gain implication would be huge. So as an instrument, REIT is a great instrument for people to roll in, one. And two, there's huge headroom for growth, even on the debt side. So that hopefully answers your first question. Your second question, which was in terms of, sorry, if you can just repeat that.
I'm saying that I wanted to check whether you do you acquire the asset at the initial stage and then
Yeah,
develop it.
understood. Yeah, sure. So if you look at the current 17 assets that we have, they've been acquired at different stages. So if you take Seawoods Navi Mumbai, which is 1 million square feet, was acquired from L&T at a time when the construction had been completed, but the leasing had been done partially. So we completed the leasing, we did renovations, etc., made the mall, it looks much better than it was 5 years ago. Bhubaneswar, for example, was in a similar state. So we buy assets which are either brownfield or operational. Number two, they have to be accretive. So one key thing is that they have to be accretive because the entire acquisition strategy is that you're not like if you were building ground up, you would take 5 to 7 years to start for cash to start accruing to your asset because it takes 3 to 5 years to build, another couple of years to stabilize. So what we do essentially is not take the construction risk. We essentially look at assets that are complete physically, and there is leverage in terms of being able to lease either fully or partially.
Mr. Sehgal, it was a pleasure talking to you today. The Nexus Select Trust REIT opens on May 9th and closes on May 11th with a price band of 95 to 100. Thank you very much for joining us on IPO Adda.
Thank you so much for having me on your show.